What's up, everyone? It's Kadi with MoneyVest. So markets here selling off a little bit on the day with the S&P 500 obviously down close to 1%. We got the NASDAQ dropping a little bit over 1.7 and the Dow Jones here also falling over 78 basis points. We did see, of course, some headlines that resulted in some significant sell-offs. Tesla here with the price cuts, Apple here obviously getting fined by the European Union, not to mention some weaker sales over in China or some lower demand compared to Huawei or Vivo. And of course, Google here also struggling with their generative AI and whether that's going to be a threatening or a riskier proposition for Google as a company. All these stocks here selling off quite reasonably well. I mean, down anywhere between 1 to 2 to 3%, 4% here on the day, which is obviously dragging down the entire market. Technology here, big tech more specifically, did see quite a significant pullback here on the day compared to some of the other parts of the market. So that's what we're here to discuss. Lots to unpack. As always, make sure that you drop a like and don't forget to subscribe to the channel if you're just joining us for the first time. The links to our Discord and Patreon is going to be down below if you're interested in joining us. Of course, getting access to all the members-only private videos. There's over 46 tutorials and lectures and videos that you can access that are members only, as well as all the Excel spreadsheets that are going to be quickly moving over to our moneyvest.com website, and of course access to our Discord, including all the trade alerts and trade ideas and options alerts as well. And also do connect with me on Instagram. My handle is going to be CastWRP. Would love to connect with you there. I do post a lot of interesting stories, portfolio updates, polls, and tips and strategies over there on Instagram as well. Now, moving over to some of the headlines here. So Wall Street is increasingly worried about inflation's resurgence. Now, there are a few things that I want to touch on in this video. Number one is there is potential for no rate cuts in 2024 whatsoever. There's some expectations that the Federal Reserve indeed may not even cut interest rates in 2024. We're going to talk a little bit about that. And there is some expectations for a potential stagflation in the economy in 2024 as well, and where to invest during times of stagflation. I'll give you one asset class to invest in during times of stagflation. That's exactly what I've been doing. I've actually been buying gold and silver over the last few months, and I'm actually planning on buying more because commodities tend to actually do much better during times of stagflation as opposed to times of inflation or disinflation, or when inflation is kind of stable at around 2%. Now, the reason for me going into a little bit more into commodities, whether it's gold or silver, is not a tactical move. I wanted to diversify in the first place. I wanted to buy a little bit of gold and silver and kind of have that as a store of value in the first place. I know it's not an income producing asset, but gold has, of course, held up its value really well over the years, and it's seen 10-year bull markets in the past. During the 2010, those 10 years after the dot-com bubble bursting, that 10 years, gold tended to outperform significantly compared to the S&P or the Dow Jones or the NASDAQ. And then the last 10 years, gold has significantly underperformed compared to equities. So the next 10 years, it's a big question mark, obviously, but it's a way for me to diversify, have a store of value, and if it does end up, let's say, outperforming, that's a cherry on top. If it doesn't, that's also okay, because like I said, I'm not looking for making 10 times on gold, but simply it's a store of value, it's a wave of diversification and kind of reducing my correlation against equities. So Wall Street, again, increasingly getting more worried. So prevailing concern is that inflation could enter an era of stagflation, where price increases reaccelerate while economic growth slows down. And this was most famously seen during the 1970s and 1980s, when a swift move down in inflation proved to be a head fake, and the US was left fighting higher prices for more than a decade because interest rates were cut down fairly quickly on the first signs that inflation is coming down. And that's exactly what I've mentioned in my previous videos, is that the risk of doing too early is far greater than the risk of doing too late from a Federal Reserve standpoint. That is something that we have to understand, that FOMC is going to try to push interest rate cuts as back to as possible. In other words, as farther as possible, because like I said, the risk of doing too early is far greater than the risk of doing too late. And this right here is JP Morgan chief strategist Marko Kolanovic. He says, and I quote, "We believe that there is risk of the narrative turning back from the Goldilocks towards something like 1970s stagflation, with significant implications for asset allocation." And this is exactly what Ray Dalio's also mentioned from a stagflation standpoint. And Marko Kolanovic says he expects the S&P to fall to 4,200 by the end of the year as well. A string of hotter than expected inflation reports in January have led Marco and others to conclude that inflation's bumpy path to the Fed's 2% target should have investors worried that as stocks are at an all-time high. Although it is a low probability, it is likely that investors are underestimating the chance of stagflation in the next 12 to 18 months. And of course, and I think that if anything, the last few years have taught investors that kind of low probability outcomes happens far more often than statistics suggest that it should happen, suggesting to, of course, COVID, 2022 bear market, interest rate hikes. There's a lot of things that and of course, Silicon Valley Bank failures. There's a lot of things that were low probability outcomes that actually ended up happening. Statistically, they might be low probability outcomes, but they actually did end up happening. And of course, that should teach investors that even stagflation, it's a low probability outcome. It is possible in 2024, which obviously could remove all potential expectations for interest rate cuts as well. So the U.S. economy is so strong that there might not be any rate cuts in 2024. So after more than 20 months of inflation and higher borrowing costs, investor economists and eventually Federal Reserve officials said that they expect the economy to soften this year, allowing the central banks to finally start cutting interest rates. But those expectations of a Fed pivot keep getting pushed back. While the market initially expected 6 rate cuts this year, starting in March, that's now off the table. And now the market's only pricing in 3 rate cuts in 2024. And it's possible that also starts to come off to 2 or 1 rate cuts or no rate cuts whatsoever. I've been saying that for months now. The markets need to get aligned with what the Federal Reserve is telling us. The markets continue to kind of disagree with what the Federal Reserve has been telling us and still push higher. So that is actually quite the surprising part, that even after the repricing, we continue to see a very strong rally in the markets here, hitting new all-time highs. Of course, today we did see a bit of a pullback. Now, the U.S. economy staying strong is the biggest risk to markets. This was Nouriel Roubini. This is a perma bear. I want to give everybody the context here. And perma bear Nouriel Roubini is now worried that the U.S. economy is running too hot. While there's much talk about a so-called soft landing, he thinks the economy might not land at all in a no landing scenario that sees growth continue to reaccelerate. And markets were pricing in 6 or 8 rate cuts earlier this year. Now they've converged to what the Fed is telling us, only 3 rate cuts. That's exactly what I said. And Roubini said that in an interview with Bloomberg but what if growth is well above potential because of technology and other factors, and the Fed doesn't cut 3 times, only 2, 1, some people say 0 is also possible from the Federal Reserve. So, when it comes to rate cuts from the Federal Reserve, there's only one simple indicator that we all have to watch, and that is unemployment, right? So that is jobless rate, jobless gains. However, there is one caveat to that even if unemployment starts to increase, even if there's more unemployed persons, even that initial jobless claims starts to increase, even then the Federal Reserve may pull back on cutting interest rates if inflation doesn't come down. Okay, so high levels of unemployment needs to be paired with low levels of inflation, and only then that is a perfect environment for the Federal Reserve to cut interest rates. If unemployment's high, or if it's going higher and inflation's also elevated above the Fed's target, in my opinion, they're most likely not going to be as aggressive in cutting interest rates as they would in the earlier scenario, because for them, inflation is more important and they don't want to reaccelerate inflation back up by cutting interest rates too soon. And that's exactly what I've mentioned, that the risk of doing too early is far greater than the risk of doing too late. They can handle recession later, right? But they cannot handle high levels of inflation or hyperinflation, because that is more disastrous for an economy than a recession. Some people may not agree, some people may not know. But yes, hyperinflation, high levels of inflation is significantly, greatly more painful for an economy than a recession ever will be. And that is because high levels of inflation, it becomes very, very difficult for consumers to get by. And that leads to lower margins. That eventually does lead to lots of unemployment. And to fight inflation, high levels of inflation, the Federal Reserve has to raise interest rates. And that is absolutely going to crush all debt securities, all debt, all loan products, because of the higher financing costs and people not being able to finance anything. And there's going to be a credit crunch, and it's just really going to squeeze a lot of people out. So that is a far more painful scenario in an economy than a recession will be, because if there's a recession, they can cut interest rates down to 0% really quickly, but it doesn't work the other way around. They cannot raise interest rates really quickly to 2, 3, 4%. They do it in a slow and steady gradual pace so that the economy gets accustomed to the higher interest rates. But it doesn't happen the other way around. They don't cut interest rates one by one. They just cut them all the way down to 0% to fight a recession. So that is something to keep in mind at the moment. And of course, looking at the markets here, Apple, Microsoft, Oracle, Adobe, all of tech, most of semis, NVIDIA still managed to close green. I don't know how, but it does still manages to close green. Semis, of course, seeing a bit of a pullback. We had software applications, consumer cyclical, so Amazon here down almost 2%, Tesla here down almost 4%, and we did have a little bit of healthcare and real estate and industrials all pulling back, with energy, of course, consumer defensives, a little bit of basic materials and financials, all stocks pushing higher here. This right here, again, is the entire market. This right here is going to be the performance. So energy, consumer defensives, and financials all pushing higher. Everything else selling off in the last 1 week. Again, a little bit of a split market with real estate, materials, utilities, energy, industrials, financials all pushing higher, with consumer cyclicals, healthcare, communication services, all of them pulling back in the last 1 month. Most sectors are green except for comm services, palladium and sugar prices and cotton prices pushing higher, with natural gas, coffee, lean hogs, and cocoa pulling back. Bitcoin here back under 65,000 and Ether just under 3,700 at the moment as well. So starting with, IBIT here dropping over a little bit over 8%, 8.6%. So back down to under $36. Bitcoin here, because it is selling off and getting rejected from the resistance that we talked about in one of our previous videos, of course, in our market updates. So you can see that Bitcoin here coming up to that resistance of almost 70,000 and then getting rejected and selling right back down. It almost hit a new all-time high, 69,156, and then of course dropping back down, considering how overbought it really is at the moment. Same thing with Ether, breaking out to almost 3,700 after seeing a bit of a pullback, and next resistance and target for Ether is going to be 4,800. However, it is incredibly overbought, so I wouldn't be surprised to see a bit of a pullback or a correction for Ether at the moment. Talking about volatility, so VIX also did spike a little bit over 7%, so back up to over 14.5. We're keeping a close eye on volatility. We're keeping a close eye on the VIX here. If it does end up, let's say, breaking out over 15, the next target is going to be inside this green rectangle, all the way up to 18 to 20 levels for the VIX. And of course, another very strong area of support between 11 and 12.7 inside this red rectangle for volatility. Again, when the VIX is high, it is going to be time for me to buy. I will be dollar cost averaging quite aggressively, and we'll be ready to deploy some cash here back into the markets. Looking at crude oil, and crude oil here selling off a little bit here on the week. It's down over 1.7%. So this right here is going to be the daily chart, up a little bit over 32 basis points right now, just over $78 a barrel. And resistance is going to be at $79 a barrel, all the way up to $80, $81 a barrel. And support level is going to stay put at roughly around $71 to $73 a barrel here inside this green rectangle for crude oil. Coming over to individual stocks. So SoFi here dropping a little bit over 15%. I did a video on SoFi earlier, so definitely do check that out. A lot of people took that video out of context a little bit, or maybe did not watch the entire video. I mentioned that convertible debt securities is not dilution as of yet. It will be dilution if those debt securities are converted into common equity. If they're converted into common shares of SoFi, that's when there can be dilution. And again, given how big the deal was, the expected sell-off should have been about 11.5%, but of course it ended up being over 15% because the markets are pessimistic about this type of deals, and as a result, we tend to overshoot both on the upside and on the downside. So that is something to keep in mind. It's not dilution yet. If it's converted into equity, that's when it will be share dilution. Support level is going to stay put around 5,000 points on the S&P, all the way down to 4,800. There is potential for us to get down to these levels for S&P if we do see a reasonable pullback or a dip here in the markets of 6 to 7%. Again, support level, like I said, it's going to stay put at 4,800. The more near-term support is going to be closer to 5,045 points. NASDAQ here also dropping heavily, down about 1.6%, back under 16K. This right here is going to be that all-time high and that resistance, still within the context of this higher high and higher low. But in case we see a breakdown below this higher low, next support is going to be down to inside this green rectangle between 15.1 and 15.4 for NASDAQ, all the way down to as low as 14.4 and 14.6 for the NASDAQ as well. So those right there are going to be a couple of support levels to keep in mind and watch for the NASDAQ. Talking about Apple, and Apple here definitely selling off quite aggressively, down a little bit over 2.8%, coming down to our target of close to 165. So that is going to be that target. And of course, my fair value, my intrinsic value for Apple sits closer to 150s. The lower the better. Always remember, the cheaper the better. We want lower prices, and we always want to hunt for deals, look for deals, and that is going to be that next support at 165. Talking about Amazon. And Amazon here also pulling back from that resistance of 176, 177. This right here is going to be a potential gap that it may or may not fill. And support level is going to stay put down to 155 for Amazon, all the way down to $143 for this company as well. So those right there are going to be a couple support levels to keep in mind for Amazon. Tesla here, on the other hand, still selling off and getting rejected. I did a couple videos on Tesla already, so make sure that you do check that out if you haven't already. But this right here, big resistance in the 200s, starting to sell right back down. This right here is going to be that next support, 151. That's going to be that next potential target here. We'll see if it actually ends up coming down to that level, but that's really where my fair value is. And of course, a more reasonable, more near-term support is going to stay put at 175, 174. That's exactly where we bounced off of more recently, and that's where we're potentially headed here for Tesla. Talking about NVIDIA still managing to close green, almost at an all-time high. I mean, this stock is just incredible. It's just insane how much of an outperformance we've seen from NVIDIA over the months. Support level 745, 635, down to low 500s. So those right there are going to be few levels to keep in mind for NVIDIA here. Advanced Micro Devices also seeing lots of buying momentum intraday. So green candle with a red day definitely does suggest there was a lot of buying activity. A lot of buyers did step in for Advanced Micro Devices here on the day. And of course, pushing up to almost new all-time highs again. And support levels going to stay put roughly inside this green rectangle, which is going to be that support in the 180s, down to as low as 160s for Advanced Micro Devices. But of course, really overbought at the moment with the RSI well over 71, almost at 72 at the moment for AMD. Next one on the list is going to be PayPal, and PayPal here on the day selling off quite incredibly here, down almost 3%. Support level is going to stay put at $57. So this right here is going to be that level to watch, all the way down to $50 per share for PayPal, and resistance going to be at closer to $67, $68 per share for PayPal, still within the context of this downtrend of lower highs and lower lows. And like I said, support level is going to stay put at $57 for PayPal. Visa here continues to pull back after, of course, hitting new all-time highs time and time again. A little bit of that negative divergence, starting to see a bit of a breakdown below that support of 280s. Next support is going to be all the way down here in the $245, $250 level for Visa. So very nice consistent uptrend of higher highs and higher lows, but this seems to be a little bit of a blow off the top rally for Visa. And like I said, next support really is going to stay put down to 245 and 250 for the company. Talking about Meta platforms, and Meta here pulling back also down about 1.6%, just under $500 per share, trading right at that support at 488. Support level is going to stay put at 451 for Meta, and all the way down to as low as 383. There were some outages for both Facebook and Instagram yesterday. They have been fixed now, I believe, but of course, support level, like I said, for Meta is going to be 451. Huge gap that may or may not get filled, all the way down to 383. Valuation is a little bit more on the expensive side, so not really interested in any of these companies at the moment, considering how much they've already rallied and how expensive they're trading at in terms of their valuations. Talking about Netflix, and Netflix here also starting to pull back down a little bit over 2.8%. So next support really is going to be inside this green rectangle, sitting down to as low as $570 per share, all the way down to sub 500, so 495 down to as low as 485. For Netflix, and resistance and targets going to be all the way up to $700, $697 to $700 per share for Netflix. And of course, support level is going to stay put at sub 500 down to as low as 480 for Netflix as well. Talking about Google, and Google continues to struggle a little bit, down about 30 basis points, continues to sell off. RSI is coming down to pretty oversold levels. So is the MACD, and next support really is going to be down to $126, $127 per share for Google, and resistance, of course, stays put in the 140s to 144, up to as much as 150 for Google as well. So those right there are going to be few resistance levels to keep in mind. Microsoft here also aggressively selling off, down almost 3%. Pullback that was much overdue, long overdue here. Next support is going to be down to as low as $384, down to as low as $366 for Microsoft, with the resistance staying put at close to 420s for Microsoft as well. And finally, we come over to Enphase. Enphase here struggling a little bit, which was up basically 90 basis points, so kind of validating that support. Does seem to be forming a little bit of a symmetrical triangle here on a very shorter time frame. So if you'll notice that this right here seems to be a lower high and a higher low, so there could be a bigger breakout or a breakdown coming up very soon here. Big move coming up for Enphase here fairly soon. Resistance going to stay put up to 138, up to as much as 151 for Enphase. So hope you all enjoyed this video and a complete update on the markets. We've got the unemployment numbers coming out this Friday, so that's going to be super important for the economy and for the markets, of course. But let me know your thoughts down in the comment section below. As always, make sure that you drop a like, subscribe to the channel. Links are going to be down below for our Discord and our Patreon if you want to join, be a part of our MoneyVest community. And as always, happy investing, and I'll see you all in the next video.